When oil prices suddenly change in the world, it does not only affect big companies or governments, it quickly affects everyday life, such as transport, food, electricity, and almost everything that needs energy. Even if people do not follow financial news, they still feel the impact in their daily expenses. What makes oil special is that it is connected to almost every part of the economy. Because of this, even a small change in oil price can spread widely. We need to understand that oil prices do not move randomly. They move based on supply, demand, and also human emotions. When something happens in the world that affects oil supply, people often react very quickly. But the reaction is not always based on what is actually happening at that moment. It is often based on fear or expectation of what might happen next. A good example of this was the 1970s oil shock, known as the 1973 oil crisis. During this time, oil prices increased very quickly in a short period. The main reason was a reduction in oil supply from certain countries, but the bigger effect came from fear. People believed prices would keep rising, so they changed their behavior immediately. Because of this fear, many people and businesses started buying more fuel than usual. Companies increased prices in advance because they expected costs to rise further. Governments also tried to control the situation, but the speed of change was faster than their response. After the first shock, the situation did not keep worsening forever. Instead, the market slowly started to adjust. New oil sources were explored, and countries worked to balance supply and demand again. People also started using less energy when they realized how expensive it had become. This stage is called stabilization. It means that the worst part of the crisis is over, but things are still not fully normal yet. Prices may stay high for a while, but they stop rising so quickly. However, even when the real situation improves, people often still think the crisis is continuing. This is where psychology becomes very important. People do not change their thinking immediately. Even if oil supply becomes more stable, they may still expect prices to stay high. This delay between reality and perception creates confusion in the market and in daily life. A similar pattern happened again during the Gulf War in the early 1990s. This event also caused sudden fear in oil markets because people worried about supply disruptions. Prices increased quickly again due to uncertainty about the future of oil production. But as time passed, the situation became more clear than people first thought. Oil supply did not collapse completely, and systems adapted again. Because of this, prices started to stabilize and eventually move back toward more normal levels. This shows a repeating cycle. First, something happens that shocks the system. Then prices rise quickly because of fear. After that, the system adjusts and becomes more stable. Finally, prices often correct themselves when people realize the situation is not as extreme as they first thought. The important idea is that oil price changes are not only about physical supply and demand, they are also about how people think and react to information. When people see prices going up, they often assume they will keep going up. When they see prices falling, they may assume they will keep falling. This kind of thinking can make price movements bigger than they would be otherwise. Another important point is that different groups in society react at different speeds. Traders and markets react very quickly because they watch prices all the time. Governments and large companies react more slowly because they need more information before making decisions. Regular people usually react based on what they see in their daily lives, such as fuel prices at stations or transport costs. Because of these different reaction speeds, the market often moves in waves. First, traders react and prices change quickly. Then businesses adjust their plans based on new costs. Finally, consumers feel the impact when prices reach everyday goods and services. This chain reaction spreads through the economy step by step. Over time, people begin to learn from these cycles, but the learning is not perfect. Each new crisis feels slightly different, even though the underlying pattern is often the same. This is because details change, such as political events, supply conditions, or global tensions, even if the general structure remains similar. This is why studying past events like the 1973 oil crisis and the Gulf War is useful. It helps people see that sudden price changes are often part of a repeating system, not completely random events. When people understand this, they can interpret news more calmly and avoid reacting too quickly to short-term changes. A good idea is to think of oil prices like waves in the ocean. They rise when there is a shock, then slowly settle, and sometimes move in the opposite direction before becoming stable again. This does not mean everything is predictable, but it shows that behavior in markets often follows patterns that repeat over time. In real life, there are many other factors that can affect oil prices, such as technology changes, new energy sources, wars, or economic growth. But even with all these differences, the basic pattern of shock, adjustment, and correction can still be seen in many historical moments. Another important idea is that people often remember extreme events more strongly than normal times. This means that after a crisis, people may believe that high prices or instability will continue longer than they actually do. This memory effect can influence decisions in markets and everyday life. Finally, understanding these patterns can help students and learners see economics in a simpler way. Instead of thinking of prices as random numbers, they can be seen as part of a system that reacts to events and human behavior together. This perspective makes financial history easier to understand and less confusing. We can also apply this thinking to modern situations. Even today, oil prices still react to global events in a similar way. When something unexpected happens, prices can move quickly, but over time, markets usually adjust as new information becomes available. This is why short-term changes should be viewed carefully. Looking at history also teaches us that not every price spike leads to a long-term crisis. Some spikes are short-lived, depending on how quickly supply and demand can adjust. This is why understanding context is very important when reading about financial news. In summary, oil price history shows a repeating structure that combines real-world supply changes with human psychology. First, there is a shock, then a fast reaction, then a period of adjustment, and finally, a correction. This pattern has appeared many times across different decades and events. What makes this pattern important is not that it predicts exact prices, but that it helps explain behavior. It shows why people often react strongly at first and then slowly calm down later. This cycle is part of how financial systems and human psychology interact over time. Because of this, studying past oil crises can help us think more carefully about future changes. It does not remove uncertainty, but it gives a clearer framework for understanding why markets move the way they do. We can also see that information spreads unevenly in markets. Some people react instantly to news, while others take time to process it. This difference in timing creates short-term imbalances that can affect prices. Over time, these imbalances usually correct themselves as more information becomes available and decisions are updated. This is why markets often look unstable in the short term, but more balanced in the long term. Overall, the key lesson is that oil price movements are not just economic events, but also human reactions shaped by fear, expectation, and gradual learning over time. This is why looking at history is useful for understanding modern markets. Even though technology and global systems change, human behavior stays quite consistent. People still react to fear and uncertainty in similar ways, and that is what creates repeating patterns in financial history. By recognizing these patterns, it becomes easier to understand why prices move the way they do without assuming every change is completely new or random. Patterns repeat more than expected often.